Well, greetings, my beloved clients and friends. I wanted to talk today about FDIC Insurance and what it is, and it's been in the news a lot lately, so I wanted to talk about that. So, FDIC stands for Federal Deposit Insurance Corporation. So it's federal, it's through the government, it's for deposits, bank deposits, and it's insurance, and it's a corporation. Okay, so the government decided that bank deposits need insurance. And why would a bank deposit need insurance? Well, it's because there's an inherent risk involved in depositing your money at the bank? And the answer is yes. Because if you think about any other transaction that you do, right? If you go to McDonald's, you give them $10 and you get a combo meal, right? You get something in exchange for the money you give them. Or if you go to the dealership, car dealership, you give them $40,000, they give you a car, right? You get something in exchange. But if you go to the bank and you give them $10 or you give them $40,000, they don't give you anything back. What'd you get for that money? Nothing. And why'd you do it? Well, because, you want a safe place to keep your money, and one day you want to come back and ask for it back, and you expect them to give it back to you, right? So you put a lot of trust into that bank that they'll hold on to your money and that it'll be there when you want it back, and that they'll help you make payments and stuff like that, right, through checks or debit card or credit card or wires or money orders or whatever, what have you, right? They provide that service. But it's inherently a risky it's not even a transaction. It's you giving them your money and it's trusting that they'll give it back, because they didn't give you anything in return. You can't even call it a transaction. Okay, so what do they do with your money? Do they just put it in the vault and just sit around and wait for you to come ask for it? No. What they do is they take the money from a lot of people and then they lend it out, right? When someone needs a house, they'll lend them that money to buy a house. They need a car, they'll lend them that money to buy a car. Business is trying to grow, they'll lend them money so that they could grow, right? So it's a very valuable service to the economy, because imagine how many houses would be bought if you had to pay cash. How many cars would get bought or sold if people had to save up the cash first under their mattress because they couldn't do it in a bank, right? How would businesses expand without the help of their banker, giving them credit while they're growing and establishing themselves? It'd be a much smaller economy without the service of banks. And then even the payment part, right? What if every transaction had to be in cash and you couldn't write a check or use your debit card, or it'd be hard to do a lot of transactions, especially for a business. Imagine how would a business, taking all that cash, it'd be very hard for them to grow. Now, there is one business that operates in cash, and they've built some big empires. That's the drug business. But in general, it's very inconvenient and hard for the business to manage an all cash business. If you're bigger than a lemonade stand. So the government wants banks to do their service because it is a very valuable service, and they need the people to trust the banks and to put their money in so that the banks can go out and lend it out, right? And so they say, hey, don't worry that we regulate these bankers and you can trust them. And if you can't, if for whatever reason this guy takes off with your money with his secretary and goes to the islands, we'll backstop that because we made him pay FDIC insurance premiums, and if something happens, we'll pay for it, right? If he makes a bad loan and he doesn't have enough to pay you back, we'll take care of that. Or even if it's a good loan, but the money's out and he can't give it to you when you need it because a lot of you asked for it at once, we'll take care of that, right? Or if a lot of you ask for it at once and he simply doesn't have it because he doesn't keep that much cash, right? We'll take care of that. That's what the FDIC insurance does. It assures the public that it's okay to put money in a bank, right? Because without that assurance, the banker couldn't do what he does. Okay, so it's very important that people trust the banks, that the bankers make loans, and that the government gives the people the assurance and the confidence to do that, you know? So, but it is insurance because there is a risk, right? And it needs to be insured. It's just like when you get a car, let's say you spent $40,000 on a car, there's a certain risk because you need that car to get to work, let's say. It was hard for you to come up with that $40,000, let's say. What happens if your car gets stolen? Man, you're out a lot of money, right? Or what if you wreck that car? And you got the money to make the car payment, but what if the damage is $10,000 or $20,000? A lot of people would be put in a bind by that. What if you hit somebody and that person has to go to the hospital and the bill is $250,000? How are you going to pay for that? You don't have that kind of money. Or what if, in your 1985 Toyota Corolla, you hit a 2020 Bentley, right? And the damage you had to fix that guy's car, So there's a lot of risks when you have a car, when you drive a car, and any one of those things could devastate a person. So what they do is they get insurance, right? They get together and a bunch of people give the insurance company a monthly premium, a small monthly premium, and then the insurance company takes the risk. The risk is transferred to the insurance company. The insurance company bears the risk, and out of the 100,000 people that they insure, it's based on the law of big numbers. It needs to be. They know 100 people are going to get in an accident every month. Maybe a little bit more, a little bit less, and they're going to have to write 100 big checks a month. But they're getting 100,000 little checks a month, and they understand the risk of their investment, and they make sure of their business, and they make sure that the little checks that are getting in, on average, are able to cover the big checks that are going out, with a little bit left over to have a profitable business. Okay, that's how insurance works. But let's say the insurance company, it's a different insurance company, and they insure houses, and they specifically insure houses against fire, right? So someone is smoking and they leave the cigarette on the couch and the house catches on fire and destroys everything. Well, the insurance company will take care of that. Or if lightning strikes a house and it catches fire and destroys everything, well, the insurance company will take care of that, right? But what if this insurance company insures houses in Northern California and there's a 85,000 acre forest fire that burns 1,200 houses, right? And in 1 week, the insurance company gets 1,200 claims all at once. That's very difficult for the insurance company because they get a few checks a week, and if they get a bunch of little checks every month, and they expect to write a few big checks every month, and on average, things come in. But what if they all come in at once because of some exogenous event like a forest fire, right? It's very difficult for the insurance company to manage that kind of risk. So what do? They insure not just one thing, but different things. They insure houses and cars, flood and fire, businesses and life and stuff like that, so that they don't get hit all at once from one thing. Or imagine if they insure just one thing and it's flood, right? And so somebody is taking a bath and they get a stroke and they pass out and the bath was still on, it floods the house. Well, the insurance company will take care of that. Or, the washing machine malfunctions, it floods the house. Well, the insurance company will take care of that. But what if they only insure houses in South Florida and a hurricane hits and 4,000 houses are flooded on the same weekend, right? And in 1 week, they get 4,000 claims because all they did was insure houses in South Florida against flooding. Well, that's very difficult for the insurance company to handle that kind of risk, right? They're better at handling those, the washing machine malfunction causing flooding type of risk. Okay, so FDIC insurance, it only insures one type of business, banks, against one type of thing, deposits, right? So, one banker turns out to be unscrupulous and he flies under the radar of the regulators and he takes off with money. They could handle that. One banker gets in trouble because he made some bad loans. They could handle that. One banker gets a bad reputation and all his depositors want the money all at once. They can handle that. But what if it's a hurricane or a forest fire, right? Well, what happened in the economy recently? No banker, and bankers are very, have a personality type, very meticulous. The green visor and the things and the sharp pencil and stodgy fat banker that's very careful. And as careful as he was, how could he have anticipated a pandemic that would shut the economy down? And right after that, the government floods the economy with cash and they get this unprecedented inflow of deposits in a 0% interest rate environment. So good news was that they didn't have to pay a lot for deposits, but there was nothing to invest in that was paying nothing safe that was paying more than 2 or 3 or 4%, which was fine. But then all of a sudden, the Fed jacks up rates by 5% in a very short period of time, and now those 2% investments aren't covering what they have to pay in their 4 to 5% deposits, right? It's like it wasn't that they were bad bankers per se. Silicon Valley Bank, they could have done a better job of risk management, but there are other banks that are in the same situation of COVID, cash inflow, rate hike, one after another, right? And it's very difficult environment for banks to operate in, and they're coming under pressure. And there have been 3 bank failures in the United States, 4 if you count Republic Bank, Credit Suisse in Europe. And so how is FDIC insurance going to be able to handle that? I think it's going to be a lot of stress on FDIC. I wouldn't want to be that insurance company with all that risk on my books, that I assumed all that risk. Are they going to have to raise premiums? Good news is that they're federal, meaning they could print money if they have to. And it just seems like they are gonna have to. What's the other way out? It concerns me, is what I'm trying to say. And bankers, I'm starting to hear that bankers are already starting to get timid. And we do not want timid bankers that are just that are turning down a lot of loans, right? Because they don't want to, not because it's a bad loan, because they don't want to be putting their money out. What if the depositors ask for it? That's not a good scenario. There's this book called Shoe Dog. It's about Phil Knight, the founder of Nike, and it tells the story of how he started Nike in the early years, and which was like and this period of growth, which was more than 20 years of just crazy growth, that this company that started in his garage basically became this global phenomenon over these 20 years. And he tells the story, and an integral part of the story is his relationship with his banker, because he's growing rapidly and rapidly becoming a global brand. And by rapidly, I mean over 20, 30 years. And he's always in need of cash. Not that he's bad at cash, but he's growing so fast. He gets these big orders and he can't fulfill them. Once he sells these shoes, he's going to make a lot of money. But before that, he needs to buy equipment. He needs to buy leather and rubber, and he needs to build a factory, and then afterwards the money will come. And he can't do that. He doesn't have the cash to do it because he's growing, and all the cash that he has, he's putting back into the business, but it's still not enough because the business is growing. And he's always at the bank, pleading with his banker for more money. Lend me the money. I'm good for it. And it's very risky because, here's a company that is a $3 million company becoming a $6 million company, and Phil Knight thinks he's going to become a $6 million company, but right now he's only a $3 million company, and he needs the financing of a $6 million company to become a $6 million company, and the banker's not sure that it's going to happen, right? He'll lend him according to a $3 million company, so the banker has to take a chance on this guy. And Phil Knight's always arguing, and he's always pleading with the bank, and there's no way he could have grown without the relationship with his banker. And so now imagine that's the case of any healthy growing business. They need their banker. Now imagine that banker becomes timid, not because of the shoe industry or Phil Knight or anything, just because of the environment that he operates in. That's detrimental to business. Imagine people can't get money to buy houses, or the amount of people that get money to buy houses, or the amount of money they get decreases a little bit. There's a decrease a little bit in the amount of auto loans that get approved. All those things could be a challenge to the economy, and inflation would be a challenge to the economy. So what do? Do you just go to cash? Well, if there's going to be inflation on the horizon, cash isn't really the best place to be either. There are some assets that do well in an inflationary environment, like real estate, hard assets, real estate, gold, Bitcoin, and a business that is able to raise prices tends to do well, especially if they have assets. Let me give you an example. Let's say you had a $500,000 house, and because of inflation, it's now a $100,000 house. It's not that you did some kind of remodel to it, or the neighborhood all of a sudden got better. It's just simply inflation, right? Same house, devalued dollar. So now it takes $1 million to buy the house instead of 500 because the dollar went down, nothing you did to the house. Okay, so that asset retains its value in a time of inflation. Now imagine that $500,000 house, you actually have a $350,000 loan on it. $350,000 fixed rate loan. Okay, so your equity in it is $150,000. Your neighbor who has his cash, has his house paid off, his equity went from $500,000 to $1 million. Your equity went from $150,000 to $650,000 because you have that loan. right? So his equity doubled, your equity 4x'd and a little bit more. Okay, so it's good to own assets in a time of inflation. It's almost even better to own leveraged assets in a time of inflation, especially if that loan is a low interest rate, fixed rate loan. Okay, because let's say your payment was $2,000 a month, and you make $20 an hour, so it takes you 100 hours of work to make your payment every month. Well, now because of inflation, right, prices of stuff goes up, your wages also went up. Now you make $40 an hour. You didn't get a raise or a promotion or anything. It's just inflation, right? So now it only takes you 50 hours of work to make your same payment, right? So it actually feels better, right? So assets are good in a time of inflation. Leveraged assets, if they're leveraged conservatively and intelligently with fixed rate, low interest debt, are even better if those assets generate really good cash flow. And if that cash flow is what economists call elastic, meaning when prices go up, I can raise prices. That means it's elastic. Some things, if you were to raise the price, you would lose customers. That means it's very elastic. If when you raise prices you don't lose customers, that means your demand curve is inelastic. Okay, so what we are looking for in the environment that we're in, because we got to manage this, because there are challenging times ahead, and you have to be on your toes in this environment. So, we're trying to take risk out of the portfolio, but that doesn't mean going to 100% cash. It means, we are raising some cash, we are buying some bonds, but we're also looking for companies that have, they're called asset heavy. Some businesses are asset light. We'd rather have an asset heavy business in this type of environment that has leverage, because there's a company we're looking at, and they took out, when interest rates were low, they took out some debt. They didn't need to, but they did. And they got low fixed rate debt on their books. And it's a growing company with good cash flow and heavy assets. Right, I'll tell you about it after I buy it. But that's the type of company we're looking for. And they're able to raise their prices and not lose customers because they sell a critical service, right? Like when the gas goes up, you complain, but you still gotta go put gas, Other things, price goes up, you'll look for an alternative, or you'll just stop buying that thing. So, and I'm telling you this because in case you have a friend that has a financial advisor that is just telling them, just hang in there, we're gonna ride through this and we'll be all right in the end. Well, here's the thing, that's good advice 95% of the time. Because over time, the US economy is great. There's some fundamental good things about the US economy. And our greatest corporations get ahead, and they keep incrementally growing over time. And through thick and thin, through war and peace, and Democrats and Republicans, and inflation and deflation, this and all, over a long periods of times, it's gone up and to the right, and so for the most part, the best thing to do is just don't panic, ride through it, and in the end everything will be all right 95% of the time. But there are a few occasionally the time comes when that's not the best advice. In 2000, that wasn't the best advice. In 1970, that was not the best advice. And in 1930, that was not the best advice. Pretty much the rest of the time, it was good advice. But there are occasions when you do have to make changes, and you do need to be open-minded and evaluate and protect and change course, you know? So I think 2022, 2023 is that kind of environment. I think that this COVID shock, the cash infusion shock, and the interest rate shock are gonna break something. And there's gonna be winners and there's gonna be losers. And we gotta be on our toes and be thinking open-mindedly and not just, you know, give you the standard, just hang in there, ride it out, everything will be okay. So feel free to share this video with your friends, maybe just to hear another opinion, and we'll be in touch, and we're going to do our best to navigate through this, and it's the time to have the hand on the wheel, and I think we are going to have to make some turns and not just plow on straight ahead. All right, so that's what we're here to do for you. Hope you guys have a great week.